growth rate. We know that, we know this, but we don't know, we know this, we know that. We want to find that out, but we don't know this at all. We cannot have two unknowns in the equation. We need to have one unknown, RA. How to find G? Well, G has to be estimated. You have to estimate G. Nobody will come and give you the G that easily. How do you estimate G? The different ways to estimate the forecasting. You take the historical part, historical series of G from the past and forecast in the future. Extremely inefficient way. Extremely inefficient way. The cost of equity is very sensitive to the growth rate. If I give you that and that, if I give you that and that, the whole class, and say, find me that, but you have to find the value of G. If I give you price and dividend, and say, find me return, cost of equity, but you have to estimate the value of G. You take the past series, 5 years, 10 years, daily, monthly, weekly, whatever, growth rate from the past series, and use the past series to forecast G. Everybody will give me a different number. This will be different. Because the whole formula is very sensitive to G. Cost of equity is very sensitive to G. And another important thing is, another important thing is only applies to companies that pay dividend. This only applies to companies that pay dividend. If D naught is equal to 0, what happens to RD? If D naught is equal to 0, this part disappears. It's down to G then. If the companies don't pay dividend, if D naught is equal to 0, then we got a problem. Some companies don't pay dividend regularly. Some companies pay very little dividend very infrequently. Then the rate of return will be difficult to estimate. Estimating growth rate is not easy, no matter what statistical method you use. If I give you D naught and P naught and ask everybody over here to find me return, everybody will give me a different answer. Because everybody will give you a different G. Everybody will give a different G. So it's very, and applies to the company that pay dividends. If that's 0, then this drops out and we have R is equal to G. Does not take into consideration risk at all. How can you have return without risk? Return depends upon risk. How can you have return and risk? There is no measure of risk anywhere. Return and risk are two sides of the coin. You got to play with return, you got to play with risk. So equation 2 is difficult to measure, and people do not, financial people do not use this formula often. Accountants do, but we don't. What do we use? We use security market line. Remember the security market line? Risk-free rate, beta, market return, risk-free rate. We have done this before. If you drop the expected sign, the actual security market line is equal to that. This is the expected security market line because it's based on expected value. But if you drop the expected sign and the actual return, actual security market line is equation 4. We know that, we know that, we know that, and we will know that. Everything from this is available from estimation. Everything. We know the market return today, we know the risk-free rate, and we know the beta. These things are all available. And if you go by that, then we can find that. And applies for all companies. There is no limit. Whether they pay dividend or not, it doesn't matter. Okay. Company 1, company 2, and company 3 will have different returns. Look at equation 4. Company A, company B, and company C will have 3 different rate of return. rate of return. Why? Yes. Because different beta. This is common for everybody. The risk-free rate. 3 months treasury bond, UK, US. That's common for everybody. The market rate, the market portfolio, everybody sees that. That's not my property, that's not your property, that belongs to the market. So this is common for everybody, this is common for everybody, and this is common for everybody. What's different for company 1, company A, company B, company C, company D, company whatever, is they all have their own individual beta. Individual beta means individual risk. Some are above the market, they have beta higher than 1. Some are below the market, some beta less than 1. And return will go up and down based on that. And that is applied for all companies. Whether company pay dividend or not, whether they are big or small company, size effect is not there. Return can be measured. All those things are available. The beta is available, the risk-free rate is available, and the market rate is available. Includes and adjusts for risk, and that does it by beta. Whoa. Cost of debt. Cost of debt. That's easy. Like I said, coupon rate on the bond. The cost of debt is the easiest thing. It's a coupon rate on the bond. It's given to you by the firm, by the company, by the government. That's all they're willing to pay you with the coupon rate. It's written on the piece of paper. There is no argument, there is no fight, there is no nothing. You like it, you take it. You don't like it, you go somewhere else. There is no dark room. There is no dark room. People who invest in the stock market, what do they keep it, what do they look at every day? People who are investing in the stock market, people who invest in the stock market, what do they keep an eye on day by day? In the news, in the newspapers, internet. What do they watch? To see whether the money is making money or the money is not making money. Whether the investment is getting better or not. What do they look for? If I'm a stock investor, stockholder, not a bondholder. Every morning I wake up, I turn the internet on, and I'm initially looking at emails. What do I look for to keep an eye on my investment? The price of the stocks. The price is going up, my investment is going up in value. Price going down, my investment is going down the drain. Price of the stocks, my stocks, and price of the stocks in the market. FTSE 100, S&P 500. So see where the market is going. Check that. That and that. My personal return and that. Based on price. Based on price. You look at the price to see how things are going up and down. What does this guy look at? This chap is a bondholder. He doesn't have any stock. He's a bond investor. He doesn't look at the coupon rate. That's fixed. He doesn't look at the face value. That's fixed too for him. What does he look at? He looks at something. He must look at something, otherwise. Yes. News about the default. Do they announce news about the default? Profit? The stockholder is concerned about the value of his investment, right? So he looks at the prices. Because price shoots up, his investment gets bigger. Price goes down, his investment is dying. Bondholders have the same problem. They're looking at the value of his investment, the value of his bond. What determines the value of the bond? We did the bond formula about 3 weeks ago. What determines the value of the bond? Interest rate, the market interest rate, the yield to maturity, the market yield. As the interest rate is rising, his coupon rate is fixed. If value of the bond is going down, and the interest rate in the market is falling, the interest rate is not fixed. Coupon rate for this particular investment is fixed, but the market interest rate is going up and down like exchange rate, like stock prices. He's keeping an eye on the interest rate to see whether his bond is gaining value or reducing value. As the interest rate falls below the coupon rate, his bond becomes a premium bond. As the interest rate goes above the coupon rate, his bond becomes a discount bond. He's losing value. So both keep an eye. Bond market, bond holders look at interest rate, and stockholders look at stock prices. Given that, what is weighted average cost of capital is that? Weighted average cost of capital is the weighted average of the cost and debt, equity and debt. It is a discount rate. This is an interest rate. It is an interest rate. This is an interest rate. Now, one of the things is assumed is that debt to equity remains constant. Debt to equity ratio remains constant. So DOE is fixed. Debt to equity ratio is constant. It assumes that debt to equity is constant. Does that mean debt and equity don't change? Does that mean the size of debt, which is in pounds or dollars or yens, whatever, and equity, which is also in dollars or yens and pounds, do you think they stay the same? The ratio stays the same. Debt may go up, but then equity has to go up. That may go down, then equity has to go down. The ratio, they assume, is fixed. This can change and that can change, but they're two. The ratio doesn't change. 40% is 40%, 10% is 10%. And why would they assume that? So what is that? What is weighted average cost of capital? It's an interest rate the company is very concerned about. It's an individual interest rate for each individual company. Interest rate or discount rate is common in the market. You open the back of the newspaper, you see a list of interest rates that exist in the market. But company A has their own interest rate, their own individual interest rate. Company B has their own individual interest rate. And they are different. Company A interest rate can be different from company B. Company C has their own individual interest rate. Like they have their own beta, have their own stock price, they have their own interest rate also. Each company has their own beta, the risk based on the risk of the company. Each company, because of that, has their own return, equation 4. Each company has their own stock prices. Now, based on this, each company has their own discount rate. With each company's debt to equity ratio is different. Company A, debt to equity ratio is different from company B and company C. And because of that, that discount rate is different for each company. What does that do? So, E is the market value of the firm's equity. Number of shares outstanding multiplied by price per share. What does number of shares outstanding mean? Any ideas what number of shares outstanding means? We talked about this before.
The number of shares in the market.
Number of shares in the market. He beat you. You raised your hand.
Sorry.
Number of shares in the market. So if a company has 1,000 shares in the market, their share outstanding number is 1,000. It's a numerical value. It's not a percentage. It's not an interest rate. It's a numerical value. If some company has 10 million shares outstanding, which means 10 million shares are out in the market, primary and secondary market put together. Multiplied by price per share. So E, does E stay fixed or changes? Changes. This thing changes every minute. Price per share change every minute, every 5 minutes, every 10 minutes, every day, every month, whatever. That may stay same for some time. Unless the company goes to the primary market and injects more shares into the market, shares outstanding will stay the same. That doesn't change as much. That changes all the time. Higher the share, higher the value of the equity. Imagine this stays the same. This stays at 1 billion. And this goes up and up and up and up. That way the market value will go up and up and up and up. If there are 10 million shares out there and company has no desire to inject new shares in the primary market, have no desire to sell more shares, only they can change the shares outstanding. You can't do it, I can't do it. Only company can come out and say, we want to inject 1 million more shares in the market, in the primary market. Then their share outstanding will go from 10 million to 11 million. And companies don't increase the share size all the time. They do it now and then when they need money very quickly. So that number can stay the same consistently. That changes. Goes up, this goes up. This goes down, this will go down. D is the market value of the firm's debt. Number of bonds outstanding multiplied price per bond. What's the number of bonds outstanding? Same thing. Number of bonds that are out of the market. Number of bonds that the company has sold to investors outside, primary market, secondary market. Similarly, companies do not increase the size of bonds regularly. They don't. They don't want to borrow more money. They only borrow money when they desperately need more money. The number of bonds in the primary market and secondary market usually stays fixed to a large extent. There are two ways to raise funds. Companies have two ways to raise money. Two major ways. They can raise money other ways also, but two major ways to raise money. Increase the share ownership or increase debt. And they don't like to do both because that brings them money. Shares bring them quick money, bonds brings them quick money. They want to raise a large amount of money relatively quickly, shares outstanding, and bond outstanding can be increased. But companies don't do that. They don't like to increase share ownership or the debt. Who wants to borrow more money? You want more money to owe somebody else in 10 years' time, 5 years' time? As a person, we don't like to do that. We don't like to borrow money too much. Companies do the same thing. They don't have to borrow money too much. Price per share, what's that? Why would that change? Coupon rate is fixed, face value is fixed, coupon payment is fixed. Why would that change? If that doesn't change much, and that doesn't change much, then that is D is fixed. But does it stay the same? Price per bond? Coupon rate is fixed. Coupon payment is fixed. Face value is fixed. Then why is the price of the bond changing?
Interest rates and the market
Because
change.
interest rate in the market changes. The value of the bond depends upon the interest rate in the market, not on coupon payment or face value. So interest rate is changing, so the price or the value of D will change. That stays fixed pretty much, that stays fixed a lot. These two guys are changing. They go up, this goes up, they go down, then D and E goes down. Combined value is equal to E plus D, equation 5. If you divide equation 5 by V, then you get that. These are the weights, these are capital structure weights. E divided by V and D divided by V. What does this equation mean? Meaning equal to 1 means what? 100%. Meaning 1 is 100%. You divide this by V, you get this equation. Here, this ratio and this ratio are the capital structure weights. Put together, they have to be 1. So E over V and D over V cannot be more than 1, right? Cannot be more than 1. Put together, they equal to 1. One of them can be equal to 1, that means the other one is 0. Okay, here's a question. Is that possible? Is that possible? Let's go with that. That's not possible. Is that possible? Is that possible? Is that possible?
No.
no? Who's saying yes, this is possible? 4 people raising hand, you know, 170 people in this class. Come on, don't yell. Chicken all the time. Is this possible? Is this possible? Possible?
Yes.
Possible?
Yes.
I'm giving the answer. Possible? Not possible. Why is that? Why? Logically, not equation. Don't look at the equation. Give me the logic. Why is that?
Because the ownership can't.
Ownership cannot be zero. A company won't exist. Ownership always has to be there. Debt may not be there. You may not borrow money, but you have the ownership. If ownership equity value is zero, that means the company doesn't exist. Company doesn't exist. Who's borrowing money then? Logically, E over V cannot be zero. Debt can be zero. That means company is completely based on ownership, shares, savings. They don't have any borrowing. If you don't exist, you're not borrowing money. Unless you do some kind of fraud. If you don't exist, you're not borrowing. But you can exist, but not borrow. You can exist, but not borrow. Live your life on not borrow money at home. Some people do that. So a company, in order to borrow, have to exist. And if they exist, there is ownership. So those weights are weights. Those guys are weights. Simple example. That's millions. That's that. Put together equal to 1. So that's a very simple example. Given the structure weight, what does the WACC look like? And the WACC looks like that. Given the weights, the WACC looks like that. That's the weight of the equity multiplied by the return of the equity plus weight of the debt multiplied by the return of the debt. That security market line and that given to us. RD is not the interest rate in the market. This is the coupon rate. RD is the cost of capital on its cost of debt. It is not something we estimate, but it's something given by the owners, the guy who are borrowing the money. RE has to be calculated. It has to be calculated by security market line. And that's the required return on equity, required return on debt, as stated earlier, is the weighted average cost of capital. Why would each company will have this different? Why would it be a standard WACC for the country or for the market? Why would company A, B, C, and D, and E will have their own version of WACC? Company A will have a different WACC from company B. Company C will have different from company D. Why? Based on this equation. Everything is different for each company. Capital structure is different, the weights will be different, the required return will be different depending on the data. And RD will be different depending on how safe the company is. Every variable is different for each company. The beta will decide the required rate of return. Market return and risk-free rate is the same for everybody. Security market line equation 4, the difference will be the beta, which will give a different return. That's going to be different. Each company will make an offer based on how the default risk of that company. The default risk is low, RD will be low. Default risk is high, RD will be high. And the capital weights will be different. We know this much, this cannot be zero. If that is zero, this will not exist at all. Without that, this guy is not there. Now this guy can be zero, so this part is gone, but this part stays. But if this part is zero, which means there is no ownership, which means the company doesn't exist. Somebody has to own the company. The company has to be alive for it to borrow money. If the company is not alive, it cannot borrow money. here's even a more simple example. Carrying on the same thing. Suppose this is 10%, which is 0.1, 7%, and if you put the calculation together, you get 0.94%, which is between that and that. Assuming between required return on equity and required return on debt. Will that be higher than that? Or that be higher than that? Is it required rate of return on debt higher than on equity or the other way around? What would you expect in the real world? What would you expect? Which one would be higher and why? Which one would be higher and why? Do you expect, who will pay the higher return? The one who is more riskier or less riskier? Which one do you expect to be more riskier, the stocks or the bonds? So which one will pay higher return? Capital and equity. That's the theory. Real life. Adjusted weighted average cost of capital. Equation 6, is this equation 6? Yes, equation 6 over here does not take into consideration taxation. Tax is important because after tax that you get to spend, whether you give away a dividend, whether you buy groceries, or pay rent, or pay mortgage, or buy clothes, or feed your kids, or whatever, is after tax. After the government takes their share, that's what you get to spend. Similarly, companies, after you pay the tax to the government, then you get to spend. What to do? Do you hold back? Invest the money somewhere else or give it away as dividend? It's after tax. Now, equation 6 does not take into consideration taxation at all. It's unadjusted. So when you adjust for taxation, adjusted weighted average cost of capital, equation 6 represents unadjusted cost of capital. Equation 6 does not take into consideration any tax. In most countries, not all, the interest paid on the debt is tax deductible. What that's supposed to mean? What does tax deductible mean? But capital gains is not tax deductible. Capital gain and dividend are not tax deductible. You have to pay tax on that. But interest you pay on the debt, when you have a debt, a mortgage debt, car loan, student loan, house loan, you pay interest. If you don't pay all your credit card bill every month, then you pay interest every time you pay little by little. That's a fact of life. If you pay the credit card bill in one go each month, then you don't pay any interest. But if you pay little by little, then you are paying interest. Similarly, house loan, car loan, mortgage loan, you pay interest. So interest have to be paid on the debt. When a company borrow your money by sending you a bond, they give you a coupon payment every 3 months, every 4 months. Coupon payment is the interest they're paying towards you, to you. That interest is tax deductible. What is that supposed to mean? You take that out from your tax liability before you pay the tax. If you have to pay £10 million as tax and your interest payment has been £3 million, you pay 7 million tax. You take 3 million out. Government gives you that right. The companies. Now, there was a time till the 95 and 96, that on UK citizens, mortgage payments, tax interest payment was tax deductible. Whatever interest you paid during this 12 months, from April to April, on your mortgage payment and car loan also, I'm not sure what car loan, mortgage payment, it was tax deductible. British government £5,000 of tax extra, and interest payment to the house mortgage was £2,000 that year. You took the 2,000 out of those 5,000, you only owed them then 3,000. That was tax deductible. But in 97, they changed that. It's not tax deductible anymore. So you pay tax plus interest to the bloody bank, and you cannot take anybody out of anybody. But the companies are allowed to take out tax deductible any loans they borrow, whether from the bank or from the bondholders. Any interest they pay is tax deductible. So that affects the last part of the equation. Whereas dividend paid to the investors and capital gains paid by the investor are not tax deductible. Dividend is your income. Every 3 months you got to pay at your income tax level. You have to pay the tax. Capital gains tax is lower, but still you pay tax. Given that, tax being the corporate tax rate, the equation changes that way. Now these equations I will not give. Weighted average cost of capital, 6 and 7. You got to remember that. I will not give these equations. You have to know that. Equation 7 is tax adjusted weighted average cost of capital. What is the purpose of this? I mean, one question is, so what? What is that? What is that? What's the purpose? And I gave an answer right here. It is a discount rate. It's an interest rate. It's an individual company interest rate. Each company's own interest rate. What do companies do with that? Suppose Southampton University has their own interest rate, own WACC, own discount rate. And what do we do with it? What do we do with it? We use it as a discount rate. We use it where? In any capital budgeting project. Net present value. Net present value. Remember net present value? Nobody remember that present value? 3 weeks ago. Shows how much we got to work so hard. What is the purpose of weighted average cost of capital? It can be used for net present value. Net present value, if I can remember, or something like that. A simple equation. Net present or something like that. In the example when we did capital budgeting 3 weeks ago, we used a discount rate provided by the market interest rate, the best interest rate you can find. Company A is a huge company, IBM, Microsoft, British Airlines, Coca-Cola. Company B, owned by this guy, is a local company, has 4 branches in Hampshire. 2 different companies. Capital structure is different. The size of E is different. The size of B is different. The size of D is different. The rates are different. Beta is different. His beta is way lower than the market. My beta is much higher. Or my beta is much lower. His beta is much higher. Because of that, return on cost of equity is different. Cost of debt is different. He doesn't issue bonds, but borrows money from the bank. I issue bonds regularly. Why should he and me use the same interest rate from the market? The situation is different for us. Why should he and me use the same interest rate? His discount rate based on WACC, this WACC, is different from mine. Any capital budgeting he will do, he will use his WACC. Any capital budgeting I do, I will use my WACC. The cash flows are different. For him, the cash flows will be small. He wants to start, he has 4 corner shops. He wants to start a 5th one. I belong to a company that has factories all over the world. Suddenly North Korea opens their door, and I want to go there. The capital budgeting, whether it's internal rate of return, payback period, net present value, modified payback period, requires a discount rate. Why should he and me use the same discount rate? The two situations are very different. He will use his WACC, and I will use mine. Because weighted average cost of capital includes the risk of the firm. My firm is less risky because I'm a big boy. His firm is very risky because he's a small kid. Or the other way around, whichever. So it can be used to apply evaluating investment project, and that present value becomes that. RW is the WACC. Now the next statement, explain that to me. The next statement says, if the company is a big company, if a big company is starting something, a new project in its own, in what it does already, then use the WACC. But if you're doing something different, then WACC cannot be used. In other words, a car company decides to open a car factory in China, or decides to start a new line of trucks, a new model of cars, then use the WACC. But if the same car company decides to open a financing department, or open a clothing store, or go buy McDonald's, then you cannot use the WACC. Similarly, this guy owns 4 corner shops, 4 Chinese grocery stores. If he wants to open a 5th Chinese grocery store, then he should use the WACC. But if he decides to go and do taxi service, start a taxi business, then he cannot use the WACC. He should not use the WACC. Why is that? For IBM or Microsoft have computer factories everywhere, buying and selling all sorts of computer equipment. Suddenly they decide, let's go into real estate. Let's buy a piece of land in London and New York, go to real estate. They cannot use WACC then. But if they decide to start a new line of computers, compete with Apple or something, Apple style computer, then they can use the WACC. Why? The risk is different. The risk is different for the investment. If he decides to go to taxi service and not open a 5th Chinese grocery store, the risk is different. Company's risk will change based on that. The risk factor is very different. Then you're going to use a market interest rate. But if you're expanding your business in the same line of business that you've been doing, or the company is based on, that WACC has to be used. It's the same risk then. If you own dozens of supermarkets all across UK, and you want to open another supermarket, Morrison, Asda, these guys are opening and closing all the time, then you use the WACC. But Asda decides to go to insurance company like they have. All supermarkets are now doing insurance and banking and all that. Cooperative guys, supermarket and banks. If they want to increase, if they want to go into something else, insurance, then the deal is different. The risk has to be the same. In your new project, as the same risk that you have. If you want to do something very different that your company is not used to, the risk is different. Then beta cannot be used there. Then beta cannot be used. For that, so if the business line is the same, WACC, new line of business is different, then market interest rate. Everybody with me? Okay. This is from an exam from the past. Company X has 41.4 million shares outstanding. Current market share is that. That value is 22% face value. Face value is 25 million pounds. And bond yield is that. Risk free rate is 20%. Market risk free rate is 7%. Rate of the X is 0.74. X is 0.4. What's the that? What's that? What's market risk premium? What's that? I'll talk about that. What is market risk premium? What's that equal to? Market risk, what is that first of all? Forget what's called equal to. Anybody remember? Don't give me the equation, I know the equation. Everybody knows that. Explain the logic behind that. Market risk premium. What is that? That basically is the market rate. That from CAPM, right? Multiplied by the beta is the part. That's the market risk premium, right? What that represent?
Minimum return that they should have.
That's the security market line.
Oh.
Market risk premium is what you get above the risk-free rate. What the market gives you above the risk-free rate. That's the risk-free rate, and that's the market return. What the market gives you above. That means what? It has to be positive or negative. This has to be positive. Because Rn has to be with Rn. Right? Why? We've done this before to see how many people are learned. Because market has risk, beta of 1. Risk-free rate has a beta of 0. Anything risky or riskier has to give more return. Has to give return. So that is always positive. That is that. Right? Looking at this, what I have not given you. You have to calculate back, but you have to calculate something else before, first. What's that? For people, look at me, this, what have I given you, and what is missing from you? Why am I giving you the beta, market risk, and risk-free rate? What am I giving you that for?
The expected return.
You have to calculate the cost of equity first. Cost of equity. Cost of debt is given. Right? Cost of equity has to be calculated first. Because I'm not giving you cost of equity. Right? First find value of RE and RD. Based on security market line, 13.18%. That's the risk-free rate. Right there. That's the beta, and that's the risk premium. Right? That's the total value of equity is 1.4 into 20 million. 20. 1.4 million shares outstanding multiplied by the share price of the shares. That much. Total value of debt is 0.93 into 5. Where does this come from? Current price of shares, face value is that. Debt value is 93% of the face value. That's face value, 93% of that, right? Which is that? So total market value is equal to 32.65. E over V is that, D over V is that. Where's 28 come from? That. Where's 32.65 come from? That. 4.65 is that, and 3.264 is that. That's the percentage. That's a ratio. That's a ratio that has to be percentage, right? Those two put together is 1, or 100%. Cost of debt is 0.11. Less than liquidity, right? Like you expect. This is higher than that. And you put the whole equation through, 1 minus 0.34. What's that? That's the tax rate. And that is 12.34. Between the cost of equity and then the return on the cost of equity. Between the cost of debt and the cost of equity. If we calculate the number and it's more or less, we got a problem. Has to be somewhere in between. Has to be between the cost of debt and cost of equity. Why is that? Because the weighted average, the equation is the weighted average. Equation 6 or 7 is the weighted average. The weights are these guys. And when you weighted average, the result has to be between the two weights. If I give something like this, okay?